All right, breathe. If you opened your phone today and it felt like the Middle East news hit all at once, you're not alone. But here's the problem. Headlines are loud, and the FX market doesn't trade emotions. It trades pressure points. So in this video, we're going to take the noise and turn it into a clean currency map. Not financial advice, educational scenario analysis only. And we're focusing on one thing, the US dollar. Because when shocks hit the system, the USD is rarely just another currency. It becomes the center of liquidity, hedging, and risk. So here's the plan. I'll explain what this Iran war escalation could do to FX, why the dollar can strengthen even when stocks are falling, and the exact Monday watch list I'm using: oil, shipping and insurance, rates, and the Haven complex. Okay, let's build the framework. In events like this, FX usually moves first, then commodities, then equities, then the real economy. All right, here's the context. Over the weekend, reports escalated around the US and Israel striking Iran, and Iran retaliating. And the market's biggest fear isn't only the conflict itself, it's the bottleneck, the Strait of Hormuz. Because if shipping is disrupted, or even if insurers and ship owners behave like it's disrupted, you can get an energy shock. And energy shocks don't stay inside oil. They leak into inflation. They leak into growth expectations. They leak into central bank pricing. And that leaks into currencies. So today we're going to answer one question. What could this Iran war escalation do to FX? And why does the USD sit right in the middle of it? Let's build the framework. There are 4 channels you need to understand. Number 1, risk-off flows. Number 2, oil and terms of trade. Number 3, interest rates and central bank expectations. Number 4, USD funding, the plumbing. If you understand those 4, you will understand most of what happens next. Okay, Channel 1, risk-off flows. When fear rises, people reduce risk. That means they de-lever, they hedge, they raise cash. And in FX, cash often means dollars. Not always, but often. Because USD is the world's reserve currency, and USD is the world's funding currency. So, in a shock, you tend to see high beta currencies weaken and havens strengthen. The classic haven trio is USD, JPY, and CHF. And here's the nuance. In a normal risk-off day, JPY and CHF can actually outperform the dollar because they're clean havens. But when the event turns into a funding event, when funding gets tight, when liquidity gets scarce, that is when the dollar can become dominant. So if you want to know whether USD strength will be mild or broad and aggressive, you don't only watch headlines, you watch the plumbing. We'll come back to that. Channel 2, oil and terms of trade. This is where this event becomes different than a generic geopolitical scare. Because oil isn't just a commodity. Oil is a tax. Oil is an input. Oil is a transportation cost. Oil is a confidence variable. And if the Strait of Hormuz is threatened, oil prices can jump on risk premium alone, even before there's a confirmed shortage. And if oil stays high, countries that import energy get pressured. Their trade balance worsens, their inflation rises, their growth can slow. Currencies of importers often struggle in prolonged oil shocks, while exporters can hold up better. Now, here's where USD gets interesting. The US is not the same America it was 20 years ago. In broad terms, the US has become far more energy advantaged than the major importing blocs. So if oil spikes and stays elevated, that can be a relative support for USD versus currencies like the euro or the yen, because Europe and Japan are heavy importers. It's not the only driver, but it matters. So in this war scenario, the USD can get support from risk-off behavior and relative terms of trade dynamics at the same time. That's powerful. But there's another layer. Channel 3. Interest rates. If oil goes up and stays up, inflation expectations rise. And when inflation expectations rise, the market starts to price fewer rate cuts. So even if equities are falling, the front-end rates market can move against easing expectations. And that can lift the dollar, because FX is a relative game. If the U.S. is perceived as staying tighter for longer, while other economies face weaker growth and still need easing, the rate differential can favor the dollar. Now, don't oversimplify this. Sometimes fear drives yields lower and USD still rises. Sometimes yields rise and USD rises. Sometimes yields fall and USD falls. So we don't anchor to one variable. We anchor to the mechanism. Does the market believe oil shock changes central bank pricing? If yes, USD tends to be supported. Okay, Channel 4, the USD funding channel. This is the one most retail traders miss, and it's the reason the USD can suddenly rip higher even when everyone is already expecting risk off. Here's the simplest way to understand it. A lot of the world borrows in dollars. A lot of hedging is done through dollars. A lot of trade is invoiced in dollars. So in stress, the demand for dollar liquidity rises. If you start seeing signs like wider bid-ask spreads, dislocations in FX swaps, stress in short-term funding, that can turn a normal move into a dash for dollars. And that's when you see the dollar strengthen broadly, including against currencies that usually resist it. So as we go into Monday, the question is not, will USD be strong? The question is, what kind of USD strength? A calm bid or a funding squeeze? Now, let's talk about the actual pairs, because you don't trade the dollar in a vacuum, you trade it against something. Let's start with EUR-USD. EUR-USD is extremely sensitive to energy dynamics. If oil and shipping risks stay elevated, Europe is facing an import price problem. That tends to be euro negative, especially if growth expectations weaken. So in a prolonged disruption scenario, euro-USD bias is typically lower. Not because the euro is bad, because the shock is asymmetrical. Now, USD-JPY. This one is tricky, because USD-JPY is a tug of war. Risk off tends to strengthen the yen, but higher U.S. yields relative to Japan tend to strengthen the dollar. So with USD-JPY, you watch which force dominates. If fear is extreme and markets unwind risk, JPY can surge and USD-JPY can fall. If oil-driven inflation pushes U.S. rates higher, USD-JPY can rise even in risk-off, because the rate differential matters. So on Monday, USD-JPY is your diagnostic pair. It tells you what kind of shock this is, pure fear or fear plus rates. Now USD-CHF. CHF is a classic haven. In clean risk-off, CHF can outperform. So USD-CHF may not rally the same way USD does against high beta currencies. Sometimes USD-CHF goes down even while DXY rises. That's normal. The haven complex fights itself. Now AUD-USD. For my Australia people, AUD is usually a risk currency. So if we get broad de-risking, AUD can get hit. Even though Australia is commodity-linked, the AUD often trades more like global growth sentiment than like one commodity. So if Monday is ugly, AUD-USD can be pressured. But if the shock becomes primarily an oil shock with stable global growth and commodities remain supported, AUD can recover. So AUD-USD can whip. Respect that. Now USD-CAD. Canada is more oil-sensitive on the export side. So if oil spikes, CAD can strengthen, meaning USD-CAD can go down. But if global risk-off is extreme, CAD can get dragged with risk. So again, mixed forces. Watch whether oil is the dominant driver or whether risk is dominant. Okay, now I'm going to give you the Monday FX watch list. Not trades, not predictions, a watch list. Because the watch list tells you what regime you're in. Here it is. Number 1, oil. Is it spiking and holding or spiking and fading? If oil spikes and holds, the shock is persistent. FX will price it longer. If oil fades quickly, FX can mean revert quickly. Number 2, shipping and insurance headlines. This is the hidden accelerant. If insurers keep repricing war risk coverage and ships keep pausing transit, that's when the market starts believing the disruption is real. Number 3, front-end U.S. rates pricing. Watch what the market does to rate cuts. If cuts get priced out, USD support grows. Number 4, USD-JPY. Like I said, it's the diagnostic pair. If yen is exploding stronger, fear is dominating. If USD-JPY is rising with yields, rates are dominating. Number 5, emerging market FX and credit sentiment. EM is the canary. If EM starts to slide aggressively, that's when funding stress risk rises and USD strength can broaden. Number 6, volatility. FX implied vol, especially one-week vol, and risk reversals. When the market pays up for USD upside protection, you'll see it there first. Okay, now let's run the scenarios. Scenario 1, de-escalation. Oil spikes, then fades. Shipping normalizes. The market exhales. In that scenario, USD can give back gains, risk currencies can bounce, and the FX move becomes a short-lived event. Scenario 2, prolonged tension, partial disruption. Oil stays elevated, insurance stays expensive, shipping remains cautious. In that scenario, USD tends to stay supported against importers and high-beta currencies. Swiss francs and Japanese yen also remain supported. And you get a choppy, headline-driven FX market. Scenario 3, severe disruption. This is the tail. This is when the Strait of Hormuz is effectively impaired in practice, and the market starts pricing real supply loss. In that scenario, you can get a global inflation impulse, a growth scare, and potentially a USD funding squeeze. That's when USD strength can become broad and forceful, and EM can come under real pressure. Okay, one last thing. If you trade FX around events like this, remember this. The first move is not always the real move. Weekend gaps, thin liquidity, wider spreads, that's where traders get emotionally trapped. So stay calm. Let price discover. Let the market show you what regime you're in. Because you don't need to predict, you need to recognize. And this week, the recognition comes from oil, shipping, rates, and the Haven complex. All right, that's the map. If you want to follow up, comment the FX pairs you care about most. EUR-USD, USD-JPY, AUD-USD, USD-CAD, GBP-USD, or anything else. And I'll build a clean pair-by-pair framework based on sensitivity to oil, risk, and rates. Goodbye for now, and thank you for listening. Stay safe, stay calm, and I'll see you on the next video.